what is money? Many definitions have been offered over the years, and many different forms of money have been used throughout the millennia. I would argue the best definition for money is the most saleable good. In other words, it is always the thing that people will accept as payment because they know somebody else will accept it as payment in the future. So how did the thing that is used as money go from gold to paper to digital fiat, and what comes next? This is the history of money. Our story begins before we have any recorded or written history. This story begins at the very beginning of humanity. Now, it is true that we do not have any anthropological records of barter being used as a complex system of money. This story starts at the very beginning of humanity. Imagine you and I have traveled to a new land. There's nobody else there. We are the first settlers there, and we begin to make our home. In order to survive, we need to do some hunting, maybe we need to do some fishing, and we need to build some shelters. We are each working on building our own settlements, but from time to time, you have some things that I might want or need, and I might have some things that you may want or need. For example, I may be a better hunter, and you might be better at building log cabins. Now, in reality, I would probably be worse at both of those things, but we're just imagining a hypothetical situation here. So let's say we come up with an agreement where you will build my house for me, and I will supply you with food from what I have hunted. That way, we both get more than what we could have on our own. Because on our own, I would just have food. On your own, you would just have a house. This arrangement allows us both to increase our wealth by engaging in exchange. Pretty soon, a third person comes out to our area, settles near us, and this person just happens to be really good at making things out of leather and cloth, like clothing and shoes. Now, I am in desperate need of some new shoes. From all of my hiking and hunting, my current shoes have worn out. So I go to the new settler and I say, hey, you know how to make some shoes. I will provide you with some meat if you make me some shoes. So again, we engage in free exchange in this barter, and we both get something that we want. He gets to get fed, and I get some new shoes. You look at this and say, well, fantastic, because you need some new shoes as well. So you go to the shoemaker and say, hey, I'll build you a house if you make me a ton of shoes. And the guy says, well, I kind of wanted to build my own house. But he says, I'm hungry, so do you have any food? And you say, well, not yet. So then you come to me and say, hey, I'll build you a new little hut that you can use for storage, that you can use for smoking meats, that you can use for whatever you want. In exchange, you give me some meat because I need to go get some shoes. And so I say, well, that sounds great. So I go out and do some hunting. I trade the meat to you for the extra hut that I'm using for storage. You take the extra meat that you don't have to eat and you go give it to the new shoemaker so you can now have some shoes. As you can see, it's getting a little complicated, but just wait, because a fourth person soon shows up. And this person is a fantastic gardener. They know how to splice different plants together to produce different fruits and vegetables. They know what seasons things should be planted in. They know all about how to grow food. This represents an opportunity for all of us to become even more wealthy together because of the exchange we can engage in with each other, giving up some of what we want less to the other person in order to get something that we want more. And so lately you've been having a real craving for some fresh fruit. So you go to the gardener and you say, hey, I would like to trade and barter with you to get some berries. And the gardener looks at you, looks down at your new shoes and says, I would love to exchange with you. How about you get me a pair of fresh new shoes and I will give you some fresh berries. Suddenly, you get pretty frustrated because the last time you needed to get shoes, you had to engage in multiple layers of trade in order to get that. And now in order to get berries, you have to add on one more layer to that. So you have to come to me and convince me that I need a third building to use for something else in exchange for some animal meat that I have hunted. And then you can take that and you can give that to the shoemaker and just hope that he's more hungry and he's willing to trade you for some shoes. And then you take those new shoes that you just got and now you trade them for some fresh berries. Obviously, this gets out of hand very quickly, and it reveals a problem that once you are outside of emergency situations or have even just a couple of people trying to engage in living with each other, something arises called the coincidence of wants. In other words, there are things that we all want from each other, but we might not have the resources for the things that the other person wants instead. And so engaging in barter in order to trade your way into something that somebody else wants so that you can get what you want becomes so complicated once you have more than a couple of people that it's impossible for any sort of a complex society to run this way. Now you can imagine with just these 4 people, very soon, some good would kind of rise to the top as a good that just gets traded between us because we know that somebody else is going to be willing to accept it as payment later. In this situation, let's just say maybe it is salt. Salt is something that is easily divisible. You can get a little bit of it or you can get a lot. So it's going to be easier to trade with salt than it is to be able to trade with huts. It's also going to last a lot longer than something like fresh fruit or meat. And so I can store up a bunch of salt myself and just wait before I use it as payment for basically as long as I want. And because everybody needs to eat salt in order to stay alive, I know that at some point somebody else will have some need for salt, and so I can be reasonably sure that I will be able to use it in order to trade for something else later. And this is why throughout history, in certain periods of time and in certain places on Earth, salt has been used as a form of money. But salt has a problem, and one of those problems is that it is consumable, and so the supply of salt is not necessarily stable. Another problem is that it dissolves pretty easily if it gets wet. And so all of your savings from your labor that you have stored up from building people huts or hunting for people, if it rains and you don't have the proper protection against rain, maybe all of that labor, all that saving, all that accumulated wealth just gets wiped out. And so eventually people stop accepting salt as payment because there's always the risk that it just disappears on them one day if it happens to get wet. In its place, maybe we start trading seashells with each other. We live relatively close to an ocean. There's a lot of people who have moved into our area now and they do a lot of fishing. And so seashells are something that we can trade with each other that won't get destroyed just because they get rained on. And so they solve that problem that salt has, but they present another problem. And that's that you don't necessarily have to do much hard work in order to just get more seashells. I can just walk down to the beach and I can collect as many seashells as I want. And that presents a problem because if I'm going to accept payment from you, I'm gonna want something that I can't just get super easily myself. Why would I accept a dozen seashells from you for something that I have to do a lot of work for, like some meat, when I could just go get the seashells myself by walking up and down the shore? And so while seashells have been used as a form of money, they as well did not stick around. Many other things have risen to the top and periodically been used as a form of money throughout history. Things like cattle, beads, large stones. But the one thing that rose to the top and stuck around as the permanent form of money for the longest was gold. The physical characteristics of gold made it fit pretty much perfectly as the thing that could solve the coincidence of wants, and that people would always be willing to accept as payment because they knew other people would be willing to accept it as payment. I can store gold for as long as I want, and I don't have to worry about rain or rust or time destroying it. It's actually indestructible. It is very difficult to get your hands on more gold because you have to dig it out of the ground and then you have to melt it down and refine it. This is something that takes a lot of time and effort, and usually it's more cost effective to just make something, be productive in society in order to get your hands on the more gold that you need. And so the supply of it tends to be pretty stable over time. Gold is also very easily divisible. It's malleable, so you can cut it in half, you can melt it down and cover other things with it. And so it's fairly easy to make very small denominations of gold that you can use for small transactions. It's also easy to identify because of its unique color, which means it's hard to counterfeit and hard to fake. So because of these physical characteristics, it arose to be used as money, as the most saleable good, the thing that people were willing to accept as payment because they knew other people would be willing to accept it as payment. And you could hold on to it for basically as long as you needed to until you wanted to use it. Now, this natural evolution shows a distinction between two types of value. We have use value and we have exchange value. There are certain items that have value because you can use them for a specific purpose. I want to get my hands on salt so that I can eat it or preserve meat with it. I want to get my hands on some shoes so I can wear them when I walk around. The subjective value applied to these goods comes from my ability or desire to use them in a certain way. There's another form of value that arises when you start to observe what money is, and that's exchange value. The value that people subjectively ascribe to things that are used as money is there specifically because of its value to be used in exchange. It's a place that they can store their value and then transfer that value to somebody else. In other words, the use of that good is entirely wrapped up in its ability to be used in exchange, in transactions, in payments. And for most of human history, gold only had exchange value. Yes, gold was used for things like jewelry and decoration, but that arguably arose as a result of it being valuable as money, not the other way around. And so for thousands of years of human history, physical gold coins and gold bars were physically moved around the world and used as payment, used as money. Gold was the most saleable good. It had value because people knew other people knew it had value. So how did we move from that to using paper? Well, it turns out that when you have a very stable supply of money, deflation happens over time. We're all familiar with how inflation works. When the government increases the money supply rapidly, you have more money chasing the same amount of stuff, goods and services. That obviously will bid up the prices. The opposite is true as well. If the money supply stays relatively stable, but the amount of stuff that people make increases, then you have the same amount of money chasing more goods and services. That means the price of stuff goes down over time. Imagine today we magically snapped our fingers and the number of houses across the nation increased tenfold. What do you think would happen to the prices of houses? They would collapse because you have the same amount of money chasing more goods and services, in this case, houses. What do you think would happen if the supply of cars instantly 10x'd? The price and the value of cars would instantly crash. So over time, if the money supply stays relatively stable, but the amount of wealth, the amount of stuff, the amount of goods and services that humans create increases, then those goods and services will cost less over time. As people figure out ways to get around faster, get around more efficiently, create more energy, as people innovate and invent in order to produce food faster and more efficiently, transportation, energy, construction, moving from hunter-gatherers to the agricultural revolution, to the industrial revolution. All of these things increase the amount of wealth that humans have produced. And if the money supply stays the same, that means all of that stuff will get cheaper over time. And that's exactly what happened. The money became very valuable relative to the stuff, which meant people weren't carrying around their gold coins anymore for small transactions. Starting around 1,000 years ago, people started preferring to keep their gold in storage and keep it safe because it was very valuable. And so the first banks arose from goldsmiths who already had the infrastructure in place because they already dealt and worked with gold. They had the security, they had the storage, so people would just pay goldsmiths to keep their gold for them. And in order to make sure that they could come back and get their gold at any time, people would be issued paper notes or receipts that would say, payable on demand to the bearer, a certain number of ounces of gold. And that way I knew whenever I wanted to, I could go give the goldsmith my piece of paper that said, redeem this for my gold, and he would give me my gold back. This invention of paper that was redeemable for gold allowed a few things to happen. Number one, there was a subtle transition from gold being money to gold ownership being the money. Because very quickly what happened was the gold stopped leaving the vaults. If I have a piece of paper that says, I can come get an ounce of gold whenever I want, I don't need to go redeem it for the gold and then use the gold for payment. And then that person who just sold me something, take that gold back to the goldsmith and get a new piece of paper. Instead, I can just give him my piece of paper. Because my piece of paper just says, this note is payable on demand to the bearer in 1 ounce of gold. Bearer means whoever holds it, whoever has the paper. So it can operate as the representation of the ownership of that gold, so I can just use the paper itself as payment. This subtle transition from gold being used as money to gold ownership being used as money allowed a boom of globalization. Suddenly, it was next to free in order to transact across long distances because you didn't have to pay for the security and the transportation for a large quantity of heavy gold. You didn't have to pay for the insurance just in case it got stolen. The gold itself could stay in the vault, and all I have to do is transfer the ownership of that gold to somebody else, which is a lot easier and cheaper. The second consequence of this subtle shift in money was that gold suddenly became infinitely divisible. Gold was already pretty divisible before because it's malleable, you can cut it in half, you can melt it down, but it becomes infinitely divisible if on a piece of paper I can write how much gold that piece of paper represents, which means that I can drop off an ounce of gold at the goldsmith or at the bank, and he can then issue me 100 pieces of paper that are each worth 1/100th of an ounce of gold. If I want to get my ounce of gold back, I do have to turn all 100 of those in, but I can also use one of those at a time for payment. And you can add as many zeros as you need. Paper turned gold into an infinitely divisible form of money, which it was not before. So the invention of paper allowed a boom of growth, globalization, infinitely divisible gold ownership to be used as money, and the use of that paper in everyday transactions took off like a rocket ship, to the point where pretty soon people weren't redeeming their paper for gold anymore. If I know I can use that paper for money, and at any time if I need to, I can go get the gold, there's really no reason to get the gold. I'm just opening up risk that somebody else might steal it from me. And so these early bankers got an idea. They said, hey, we're issuing out these pieces of paper and operating a savings business. But what if we also open up a loan business? They looked around and saw, hey, when people lend to each other, they're lending their own money. We don't have to because we're the ones that are creating the money, the paper that people use as money. So we can offer loans and just give people paper that we create, and we can make an infinite amount of money. Our profit is literally endless. Now, this was the invention of fractional reserve banking. In other words, the entity who is trusted to hold on to the money, in this case, the gold, decides to issue more claims on that gold than they actually can fulfill. Because remember, every piece of paper for people to trust that it is usable as money has to say the same thing on it. This note is payable on demand to the bearer in a certain number of ounces of gold, which means the bankers were committing fraud because they were telling people you can come get your gold at any time when they actually couldn't. At the beginning, when the bankers started to do this, people looked around and all they saw was a boom. People had more spending power than they had before. Prices started going up. Profits started going up. Everybody started borrowing and spending more because everybody felt like they were getting rich. But one day, this gravy train came to an end. And nobody really knows why. Maybe it's because somebody realized, well, this is debt. I've got to pay it back. So they started to pay back some of their debt, which pulled money out of circulation. And that meant less income for the next guy, which meant he had to start paying off some of his debt. This deleveraging popped the boom and led to a bust. Now, the other thing that might have caused this was somebody looked around and realized there's a lot more money floating around than there used to be. We haven't gotten any more gold shipments in. Nobody from out of town has brought any more gold. How does everybody have so much money? I think the bank is committing fraud. So that person went and they said, here are my paper dollars, give me my gold. And then they went and told their close friends and family to go do the same. After those people quietly went and got their gold, they all told their closest friends and family to do the same. Very quickly, a bank run happened. People realized there's no money, there's no gold. All of the paper in circulation instantly becomes worthless. Nobody wants it because the only reason it had value before was because they could get gold with it. And now they can't. The money's gone, the gold is gone. And so prices collapse back down to where they were before. And then they run the banker out of town or probably hang him. So this practice of fractional reserve banking, where the bank will issue more claims on the gold or on the money than they actually can fulfill, is fraud. It is making a legally binding contractual promise or guarantee that you know you cannot fulfill, which meant that this practice should have been outlawed, but instead it became nationalized. Starting around 300 years ago, governments looked at this and said, hey, wait, we don't want to completely stop this from happening because we see a way that we can benefit from this. And so they nationalized and said any bank is allowed to participate in a limited amount of fraud, of fractional reserve banking, as long as you do it through the national banking system. And we're going to put a bank on top of the banks called a central bank. Now, their genius idea was that if one bank were to fail from a bank run because they were engaging in fractional reserve banking or fraud, then that single bank would be able to draw on the reserves from the entire banking system through the central bank. A central bank is just going to operate as a bank for banks. And so if one bank gets into trouble, they can go to their bank, the central bank, and get more reserves so that they don't have to worry about a bank run. But a funny thing happens when individuals, in this case the banks, no longer have to worry about the risk of failure, then you're going to take on as much risk as possible to try and profit as much as possible, which puts the entire system at risk because now every bank is just loading up as much as they can, thinking they'll be able to rely on the central bank in a case of an emergency. And whether you go 300 years ago to the collapse of the Mississippi bubble in France, or whether you go a little over 100 years ago to the first Great Depression in America after the Federal Reserve was started, you see the same pattern happening. Very shortly after a central bank comes into power, you see a massive nationwide boom and a bust because the entire system is loaded up with claims on money that cannot be fulfilled. The false boom that occurs as a result of that easy money inevitably leads to the bust. Deflationary death spirals, bank runs, and economic devastation. Now, in the fallout of the Great Depression starting in the United States, the president at the time, FDR, decided that the real problem was not the fraud. The real problem was not the nationwide fractional reserve banking. The real problem was not issuing more claims on the money than could actually be fulfilled. He said the problem was that those claims could be fulfilled at all. He said the problem is Americans can go and get their money from the banks. So let's just outlaw that. Because if we outlaw that, then a bank run won't be able to happen anymore. And so in 1934, FDR issued an executive order to ban the personal ownership of gold in the United States. He confiscated it all, consolidated it under federal government ownership, and then, as if to add salt to the wound, raised the price of gold, which allowed him to issue even more paper dollars, whose value was only tied to gold through a legal declaration now. And what good is that if you can't actually get your hands on the gold anyway? Not much. So starting in 1934, we had the first major step in transition from the ownership of gold being transferred as money to the paper that used to represent ownership of gold being money itself. As a US citizen, we were forced by law to start using paper itself as money. Now keep in mind, for those of you who care about semantics, there is no difference between currency and money. Money is the most saleable good. Money is the thing that people will accept as payment because they know other people will accept it as payment. This can happen by free market exchange, or it can happen by government declaration. And FDR's government left American citizens with no choice but to start accepting paper as the new form of money. Now, the US government had no authority over what the rest of the world did. And so if the US wanted to continue to be able to do business with the rest of the world and buy stuff that we wanted from other places, we would still have to send them the form of money that they wanted to accept as payment, which at the time was still gold. But fortunately for America, and unfortunately for the rest of the world, something happened shortly after called World War II. Now, Europe was devastated economically after World War II. Most European nations had spent through all of their money, which again for them was gold. But at the same time, the United States had spent a bunch of that time producing the stuff that the rest of the world was buying. The weapons, the tools, the machinery. And so all the gold from around the world had slowly come back into the hands of the United States government. And so the US made an agreement with the rest of the world called the Bretton Woods Agreement, which stated that all of the other paper currencies that the other countries had would no longer be pegged to gold like they were before, like the dollar was before. Their paper currencies would be pegged to the US dollar, redeemable for the US dollar. And then the US dollar itself would also be redeemable for gold for the rest of the world, not for US citizens. The European countries didn't really have a choice, and they also didn't want to have to go back to square one and try and rebuild their gold reserves, so they all agreed, which turned the US dollar as the de facto money that was used around the world. Yes, it was redeemable for gold, so the rest of the world was trading the ownership of that gold as money, just like America American citizens used to do, but it was still the paper dollar that was in circulation. And just like every bank before them and every central bank before them, the Federal Reserve in the United States of America decided to print more claims on that gold than they could actually fulfill. We sent those paper dollars out around the world as payment for stuff we actually wanted. Those dollars wound up in circulation all around the globe, increasing the quantity of money, driving prices higher, and causing a boom. And in the late 60s, the rest of the world started to realize there was a problem. Prices were rising, dollars were abundant, and they thought the United States doesn't have enough gold to back up all of these claims on gold. So many nations started turning in their dollars back to the US government saying, give us our gold. And for a while, the United States complied. But in 1971, the United States was about 2 weeks away from all the gold reserves being completely drained. And so they just said, no, sorry, nobody gets their gold. We're closing the gold window. You can keep your paper that we gave you, but it's no longer going to be able to be exchanged for gold. We're going to keep the rest. And overnight, the same thing happened to the rest of the world that had happened to US citizens in 1934. The paper itself became money. The ownership of gold was no longer being used as money around the world, and the paper stuck. The main changes that have happened over the last 50 years or so is that we have transitioned from a physical dollar system to a digital dollar system. The dollar still acts as the dominant form of money around the world. In other words, the most saleable good, the thing that people and institutions and countries are willing to accept as payment because they know others are also willing to accept it as payment. It just happens digitally now instead of with physical paper. The various quantities of money and the histories of transactions are kept in records called ledgers. Every bank and financial institution has its own internal ledger that has a record of all of the various accounts, who the people are attached to each of those accounts, and the history of the transactions of dollars coming in and out of those accounts. At the end of the day, banks will reconcile and batch settle with each other through the central bank, who maintains its own ledger of the transactions in the accounts of all the financial institutions it oversees. These ledgers are all private. I don't have the ability to go in and look at Bank of America's ledgers. In order to participate on these ledgers, an individual must be fully identified, meaning if you want to go open a bank account and participate in the money system, they have to know your name, your birthday, your social security number, your income, your address, the car you drive, and your favorite flavor of ice cream. There's zero privacy or anonymity. These ledgers are also fully centralized in terms of their power and their control. The central bank sits at the top, where a committee of 5 to 12 people will decide the value of the money by determining interest rates and the quantity of money at their own will. Now, today, when you look around the world, there are many contenders for the future of money, the next form of money. Some of the most well-known alternatives are simply other forms of fiat money. In other words, money that is money by declaration, where a government decides, hey, you have to use this as money. That might be the euro. Some examples of these alternatives are the euro or the yen or the renminbi, but these are all just different flavors of the same thing. Some other contenders or alternatives are things like gold, which if you didn't skip this entire video, you know that most of human history, gold operated as money. It could operate as money again. And then obviously, most recently, we have the rise of cryptocurrencies, specifically Bitcoin, that offer an alternative form of money. Historically, when people stop accepting the government's form of money for payment, the government is then forced to adopt whatever the people have already moved to. You see this happening many times in many places that experience hyperinflation, where the people start using gold again as money, or the people start using a different country's currency as money. They want to get the control out of the hands of their government, who have proven to be untrustworthy with controlling the money supply and the money value, which means that a complete failure of the dominant fiat currency, in our case today, the dollar, probably means that people would not be really excited about replacing it with yet another government currency. Now, in terms of gold, it operated very well for thousands of years as money. The problem that it faces today is that the physical transfer of gold as payment is not useful in a globalized world. You're not going to be able to buy anything from Amazon by sending them a gold coin, which means that unless something catastrophic happens globally that completely eradicates the internet and global trade, we're not going to move back to physical gold being used as money. However, the ownership of that gold could be used as money. Going back to the system that served well for hundreds of years, where gold sat in vaults, and the ownership of that gold traded as money. In this case, it would be electronically transferred. Just like I use my debit card or credit card to send somebody dollars today, I could do the same thing to send somebody else a gram of gold. The gold would stay in the vault, but the ownership of it would transfer from me to them. Today, gold is used as a store of value, not as a medium of exchange, which means people buy it and hold on to it because it preserves their purchasing power. This is true of individuals all across the world, and it's also true of sovereign wealth funds and central banks. In fact, central bank holdings of gold has now surpassed US Treasuries for the first time in 50 years. And so its use as a savings tool has not gone away, but its future in use for payments is still a question mark. Now, something like Bitcoin is also a contender for the future of money. Bitcoin is much more similar to our current system of money than most people realize. It is a ledger form of money. Instead of every bank having its own private ledger that nobody else can see, Bitcoin is one public ledger that anybody can see. You can go and see every single Bitcoin account. They're called wallets, but they're accounts. And you can see how much Bitcoin each account has, and you can see the entire history of every Bitcoin transaction that's ever been made. Because it is public, it is very difficult, perhaps impossible, to hack, because anybody who's looking at it would know that it has changed. The users of Bitcoin are also not fully identified. It is somewhat private. It is a pseudonymous ledger, which means you have a wallet, and if somebody knows computers really well, they can probably track down that it's you, but your name and your social security number and all of your personal identifiable information is not necessarily attached to that wallet. It's also controlled by everybody who uses the network instead of a committee of just a couple of people, which means it is very resistant to changes in terms of its value or its quantity. Now, just like gold, nobody really uses Bitcoin for payments today. People do use it as a store of value, which means they buy it and they hold on to it so that their purchasing power can be preserved. Its future as a medium of exchange or use as payments is still a question mark. Now, the final thought I would like to leave you with is that these are exactly the behaviors one would expect when you see the dominant form of money starting to fail. This is called Gresham's law. In other words, bad money drives out good money. If you believe that the main form of money that is being used will lose its purchasing power in the future, you're going to do everything you can to get rid of it as fast as possible, and you instead will hoard and store other forms of money, other forms of stores of value. A new form of money will not displace fully the old form of money until at some point nobody is willing to accept the old one as payment anymore. So the dollar is still the most saleable good. It is a good that people will accept as payment because they know other people accept it as payment. But that doesn't mean that its foundation isn't being eroded. It's not being used as a store of value as much as it used to be. And other alternative competitors are being used as stores of value instead. And at some point, it is not only possible, but likely that one of these other forms of stores of value will be the thing that people will accept as payment. That doesn't change the fact that something being money is still just the thing that people accept as payment because they know other people will accept it as payment. Money is always and always will be, always has been, the most saleable good. The thing whose value is mostly or potentially all exchange value, regardless of any or none use value. And the beauty of it is you don't have to pick just one. You can diversify and you can buy some gold and you can buy some Bitcoin. And if you want more stuff like this that I don't put up on YouTube, I do have a free newsletter. You can start getting that in your inbox weekly by clicking on the link in the description below. As always, thanks so much for watching. Have a great day.